Hello and welcome to Introduction to Investing in the Stock Market. I am Elizabeth Booker and I am so excited to have you here with me. So this session will be recorded so you can always come back to it later. As I said, I'm Elizabeth Booker. I am the founder of Wealth from Little. I'm a financial coach and I help women of faith change the way they think about money so that they can start building wealth. I've been teaching about finances since 2008 or 2009. I used to go into schools teaching between year 7 to year 11 students about budgeting, about saving, and about getting started in investing. And that is what this session is about today. Investing in the stock market can be a very smart way for you to grow your wealth, to make your money work for you. But that needs proper guidance and proper research and understanding of what you are doing. So let's get into it. Why do we want to invest in the stock market in the first place? Well, I've come up with 5 reasons why you might want to invest in the stock market. It may not be for everyone, but why you might be interested in investing in the stock market. So I hope you're ready, you're strapped in, you've got your notes, you've got your pen, and let's go. First reason is you're investing in yourself when you're investing in the stock market. First, investing in the stock market is a way of investing in yourself by putting your money to work in stocks and by building your wealth and securing your financial future. We'll talk more about what stocks mean. But first, know that it can be a form of self-care because it's not focusing on like fancy facials right now or spa days, but you are actually treating yourself to long-term financial security. Second reason is because of inflation. As we recently heard this week, in the UK, inflation is projected to go way up to 10.4%, and that is currently reported figures. So if your money is just sitting in a current account or a bank alone, it's actually losing value each day. So inflation can seriously erode the value of your money over time, leaving your money with having worth less than it was, the month or the year before. Investing in the stock market can help keep up with inflation or even outpace it. Not always, depending on how high inflation is, and sometimes it can outpace it depending on what you are investing in. Plus, with a diverse portfolio of stocks, you can spread your risk and minimize the impact of any one stock underperforming. When people talk about, and we will talk about this later, about investing profitably, diversification is a very big part of that, right? So that you're not putting all your eggs in one basket and then that basket starts to underperform. Now, the third reason is you are making your money work for you. And what that means is that investing in the stock market is a way of putting your money to work, just like an employee, right? If you're an employer, you have employees and they're working for you, making more money for you. That money that you're earning could be working for you too. Instead of just letting your hard-earned cash sit in a low-interest savings account, you can invest in the stock market that will definitely have the potential to earn higher returns. And that means that potentially your wealth can grow much faster and you can achieve your financial goals sooner. Now, the fourth reason is sentimental reason, and that's because women rock the stock market. Research has shown historically that even though the stock market has been a male-dominated area, in recent times, women are making bigger strides in the financial world, and female professionals are showing that when they do invest, their investments and their portfolios, which is the group of your investments, are making better profits than male counterparts because we do not put in the same type of emotions, the same type of ego-based emotions that our male counterparts do. No offense. Okay, and then long-term gains, right? This is my final reason why you should be investing in the stock market. When it comes to investing, patience is key. If you do have patience, you can win here. You're not going to get rich overnight, but with a long-term investment strategy, you can potentially gain significant gains over time. So don't let short-term fluctuations put you off or scare you. If you keep your eye on the price and you remember why you're investing, you know that slow and steady will win. Now, investing in the stock market for the long term is not the only way to invest, right? And diversification is key, and that means doing different types of things. But this is just one of the ways that we're going to talk about investing. So I did a mini training before on the history of the stock market, and I think it was a very interesting training. So I'm going to add the link below so that you can watch you can listen to that summary of the history of the stock market. But before you do start investing in the stock market, first thing that I think that we should think about is what you should do before you start, right? And I'm going to talk about 5 main things here, right? First is education, right? You don't have to be an investment guru, you don't have to know everything, but you should know some things. You should know some basic things about investing, about the stock market, and about what you are putting your money into, what you are purchasing with your money, what asset you are buying, right? So knowledge is power, because when you know what you're doing, you're able to make better decisions. So take time to read on the stock market and learn the basics. You don't, as I said, you don't need to become a stock market expert overnight, but just basic understanding of how the market works will help you make better decisions. Second thing is to determine your goals, all right? What are you hoping to achieve by investing in the stock market? Are you looking for long-term wealth or a specific goal? Or are you just trying to earn extra income, or you're just trying to beat inflation, so that your money just keeps, keeps its value? By defining your goals, knowing exactly what you're trying to achieve, this will help you determine the investment strategy that you are going to make, and it will help you make smarter investment decisions now and in the future. Now, the third thing is to assess your risk. So yeah, assess your risk tolerance, and that is a big thing, because when you are investing, you need to be able to sleep well at night and not start thinking that, oh my goodness, what's going to has my money made money, or has my money lost money? 2 emotions that are at play, especially with beginner investors, can be fear and greed. Both can be very disastrous. Fear is that emotion of, I'm so scared I'm going to lose money, so I never start, or I start but I pull out. So you start investing, and then you see that your investments are dropping, right? In the short term, it's dropping because there's a pandemic, or because there's a war, or because there's something else happening. And then you see that your portfolio, your value of your portfolio is dropping, and you get scared, and you decide that, you know what, I can't do this. I'm pulling my money out. So you pull your money out at a loss. Or the flip side is you see your investments growing, and you drop your strategy, you drop your plan, and you get greedy, and you say, actually, I'm going to put all my money into this because it's growing, so that I can make a lot more money now in the short term. That's greed, and that can be dangerous, because you don't know tomorrow. I don't know tomorrow. No investment manager knows tomorrow. Even the news doesn't know tomorrow. So, assess your risk tolerance. Are you heavily risk adverse, or not. Either way, I'm not saying it's good or bad, but you need to keep in mind how you manage risk. Then build an emergency fund. That is important. You do want to have some savings that are not tied up in your investment, because if something is happening, you want to feel like something, I need some money and I can afford to make that, take the money out of my savings, right? So you don't want to be touching your investment for a need. So you want to invest money that you don't need right now, and you want to have the money that you would need saved. And then the final thing is to pay off any high interest debt. Because if you have high interest debt, such as credit card debt or personal loan, it's a really good idea to pay that off before you start investing, or have a plan to pay it off as you are investing. The interest on your debt could be, and most likely would be, if it is a credit card, higher than the returns or the potential returns you might earn from investing. So paying off that interest, that credit card debt would save you money in the long term. Right. So what can you invest in when it comes to the stock market? So there are many things that you can invest in comes to the stock market, but today we'll talk in detail about just 3 things. But you can invest in individual stocks. This is probably what most people think of when they hear investing in the stock market, because you can buy individual stocks of specific companies like Apple, Microsoft, Amazon. And what a stock is you're buying a piece of that company. So when you buy a stock, you're buying a piece, you're buying a share of that company. And as that company increases in value, you are also increasing in value based on the proportion of directly proportional to how much of that company that you own. And then you can also invest in exchange traded funds. So exchange traded funds are a very popular investment option because they offer diversification without having to buy individual stocks. So an exchange traded fund is a collection of stocks and bonds and other assets that track a specific market index or sector. What that means is, when you're investing, you can invest in different areas, and as I said, I will link the history of the stock market below. But you can invest in different regions, right? And that's what diversification is all about, is investing in different regions. So you can invest in Africa, you can invest in in Europe, you can invest in America, you can invest in Japan, you can invest in China. And then when you're investing in those regions, you can invest in large companies, medium companies, or small companies. So for example, if you invest in America, there is a popular index called the S&P 500. Now, the S&P 500 is a group of the largest 500 companies in America. The largest 500 companies in America, and they are all tracked on an index. So instead of you picking which company do I want to invest in, you can just decide, okay, I want to just pick the top 500 companies. But now you might not want to individually invest in each of those 500 companies because you might not have enough money to do so. But you might have enough money to buy a tiny piece of each. And if you invest in an exchange traded fund, what that fund does is that it tracks how the top, for example, that index, which is like the S&P 500, that is what is called an index. It tracks how that index is performing. And therefore, it means that your money will be growing based on how those group of companies is going relative to the amount of money that you are investing. Mutual funds Mutual funds are similar to exchange traded funds in that they offer diversification in investing in a variety of stocks and other assets. But the difference is that mutual funds are actively managed by a professional fund manager, i.e., there's a human being who's trained to watch those funds that you're invested in and making sure that they are profitable. And whereas ETFs are passively managed, so there's no person actually watching it. Maybe someone comes in and sets it every couple of months or twice a year or so, but there's an algorithm that is managing that. Then bonds are when you invest or by loaning money to a company or to the government. So when you buy a bond, you're essentially giving the government a loan. In return, you'll receive regular interest payments and return of your initial investment when the bond matures. So bonds are considered quite low risk investments, and in many countries this is also called treasury bills. Then real estate investment trust. Now this is the fifth way that you can invest in the stock market, and real estate investment trust is a really great way to invest in real estate without actually owning property. So a REIT, which is real estate investment trust, is a company that owns or manages a portfolio of income producing real estates, such as apartments, office buildings, shopping centers. So if you are a shareholder of a REIT, you will receive a proportion of the income generated by those properties, and your portfolio will be growing as theirs is growing too, along the same percentage line. So there are a variety of investment options that you can consider when it comes to the stock market, whether you're choosing individual stocks or ETFs or mutual funds, bonds or treasury bills or REITs. Is important, I have to say this, and I will say it a couple more times, that you understand and you do your research and you know exactly what you understand what you're doing. Just a basic understanding is good so that you can make informed decisions. You can make informed decisions, and you can make informed decisions about how to diversify your portfolio. I hope that makes sense. Okay, so next we are going to I'll talk more about funds, stocks, and ETFs. So what exactly is a stock, right? So a stock is known as a share, or it can be known as equity. It represents a unit of ownership in a company. When you buy a stock, you become a shareholder, and a shareholder in that company. And that means that you own a small piece of a company and you have a right to a proportion of its profits. Companies issue stocks as a way to raise money to finance their operations and growth. It's just like going to the bank for a loan, but instead of going to the bank, they come to you and they come to me. They're investors, right? When a company goes public, so when a company goes public, first the company is private. Like if you and I start a business, for example, and our business is a private business, it's not publicly owned, it's owned by myself, or it's owned by you, or it's owned by your family. So it's privately owned by an individual or a group of individuals, right? But if you decide that you do need more money coming into the business, you can either raise money by going to a single investor, like you see on Dragon's Den, and you see, when people go and they pitch their business to an investor, the investor says they want 50. In Dragon's Den, like the dens will say they want 50% profit, or 10% profit, or 5% profit. They want a piece of that company. So if they give you some money, they want to know that that money is growing as you make money as well. And so in the same way, if my private company decides to go public, typically that means that I'm going to start selling shares of stock to the public, not just to one investor, but to many as possible, right? And this is done in an IPO, initial public offering, right? After the IPO, the stock can be bought or sold on stock exchanges or in all markets, right? So that means you can now buy shares in my company, and as my company grows, your profits also will grow because you will be entitled to share a share of my profits. So the price of a stock can now fluctuate based on various factors. And this includes the performance of the company, changes in the market, economic and political factors. Examples are the pandemic, examples are the Russian-Ukraine war, and those are types of examples of things outside of the company that can affect the price of your share. At the same time, it can also be down to leadership. Leadership can change, affect the price of a share. You have seen when prices of shares have fluctuated for example, with Elon Musk and his companies, the prices of his shares have fluctuated, sometimes based on a tweet that he has sent. Prices in shares in properties, real estate investment funds fluctuated a lot during the pandemic because people were not going to shopping centers, they were not going to shopping malls. So those kind of things can affect the price of a stock. So some investors buy stocks in hopes of earning a profit, and then they can sell them later at a higher price than they paid for them. And that's usually called trading. And then while others, hold on to stocks for the long term in hopes of receiving dividends and enjoying, appreciation in that initial capital. And so these are some examples of stocks. So from companies like Apple, Amazon, Facebook, Tesla, Google, whose parent company is called Alphabet. Those are some examples of stocks. Now, the next thing is investment funds. Now, investment funds can be either mutual funds or exchange traded funds. Now, this is more of if, let's say, you don't know which company to buy, because if you decide that you want to buy stocks, you want to buy a mixture of stocks. You don't just want to put all your eggs in one basket. So you want to buy a mixture of stocks that are diverse in region. So from Africa, from America, from Europe, from Japan. You can choose what regions you want to invest in, and it's up to you completely. Then you want to pick a diversity of industry. So the tech industry, fashion industry, pharmaceutical industry, food industry. Why? Because if there's, for example, during this war, probably there might be the share prices in one industry might be dropping, but the share prices in another industry would be rising. During the pandemic, shares in the fashion industry was dropping, but shares in the pharmaceutical industry was rising, right? Because we were creating a vaccine and no one was going out to the shops. And so you see that as in every cycle, as some businesses are failing, some are rising. So by diversifying your portfolio and in different areas and different categories, different types of businesses, different types of companies, you're able to ensure that you're always being profitable because you're managing your risk, you're managing your exposure. And you can do that by investing in a fund, because a fund is literally a pool of companies. So it's like a potluck of loads and loads of different companies. Some funds have 8,000 companies, 2,000 companies, 5,000 companies. And here are some examples of some popular ones, where there are loads of different companies mixed in from different sectors, different industries, different regions of the world, so that when one is dropping, one will be rising, and you're always going to be making your portfolio should be always making profit. And when you're choosing an investment fund, of course, as I said, you want one that has a mixture of geographical regions, and some also will have a mixture of bonds as well, mixed in, and mixed in with the fund, not just stocks. But you also want to choose an investment fund that is and pay attention to fees, because fees is also something that happens. You do have to pay fees when you're setting up, when you start buying funds, and you want to make sure that you know the percentage of fees that you are eventually going to pay on each fund that you're buying. And every time you buy a fund, next thing that you want to know is historical performance, right? You want to know how that fund has performed in the past, because we cannot predict the future, but we can make informed decisions based on its past performance. And then you want to know, like, roughly the risk level. Does this fund invest in highly risky companies or not? And usually most firms have a KPI which you can, or an investment sheet which you can download before you buy a fund, that will let you know these things. And then secondly, fourthly, you must consider your own personal goals. That's very important, and your own risk tolerance when selecting a fund. And so again, those are some funds there for you. And then exchange traded funds, they are also, again, a type of investment fund, just like a mutual fund, except for exchange traded funds are not actively managed by a person, whereas mutual funds are actively managed by a person. Exchange traded funds are designed to track the performance of a particular index. So now we'll just talk about what affects the price, because in the last couple of years, we have seen so many things in the news about prices rising, prices dropping, prices rising, prices dropping. And what affects the price in the stock market are usually, one, company performance. This is obviously quite obvious. If the company is doing well, the stock prices will go up. Positive, earnings reports, and new product launches, when they launch new products that indicate a company is doing well, will push the prices up. Negative news like declining sales, a scandal in the company, or a scandal with the CEO, or a member of the board that is well known, can cause prices to drop. Then next thing is emotions, right? Market sentiment, right? The stock market is influenced by the moods of its investors, and that's really the mood of you and me. So if we are feeling optimistic about the economy, usually this will usually drive the prices up, as people tend to buy more stocks when they feel optimistic. And if they're feeling pessimistic, they usually will try to start selling, and therefore the price will drop as well. So emotions play a lot in the stock market. Then interest rates, they have a big impact on the stock market, because when interest rates are low, borrowing is cheaper, and this can boost the economy and drive up stock prices. When interest rates are high, borrowing is more expensive, which can slow down the economy and cause stock prices to drop. Again, number 4 is political and economic news. Political news, both domestic and globally, can impact, the stock market. For example, the news of a new trade deal or a change in government policy can cause the stock price to rise, while news of a recession or tensions across, some geopolitical area can cause the stock price to drop. And then industry trends. That's another big one, right? Specific industries can affect stock prices. For example, renewable energy is becoming a lot more popular. You hear all these things about net zero all over the news, and stocks in that industry may rise because of this whole drive to like push for renewable energy, put for net zero energy, and with regards to climate change being very popular in the news right now. So this can all push push the prices of renewable energy stocks up, and traditional energy sources may not be may not grow as much in that type of climate. But there's a lot of things that go into it, and it's mainly around emotions, around people's emotions, investors' emotions, and the emotions of a of the country, or globally, what is happening, tensions across countries as well. So how to stay profitable. One of the things I said was I was going to share how you can stay profitable even when you're investing in the stock market. And we've talked about this, so I'm going to just recap. Here are some strategies. Number one, diversification. This is one of the best ways to reduce your risk, is to diversify your portfolio. This means investing in a variety of different assets, such as stocks, bonds, real estate, as well as in different industries and sectors, right? And this can help you reduce the impact of any single investment on your overall portfolio. Next, asset allocation. This is another important strategy when it to determine, and it's to determine the appropriate mixture of assets in your investment. And this is based on your investment goals and your risk tolerance, right? So asset allocation allows you to divide your investment portfolio among different types of assets. So this is, for example, you can decide that based on your timeline, I want to invest for the next 10 years, I want to invest for the next 20 years, I want to invest till retirement. Your risk tolerance, I don't mind risk. I will sleep well at night knowing that I invest for the long term, or I'm really scared that I'll lose my money and I don't want to have sleepless nights. And then your main goal, okay, I want to grow my money and have some income in retirement. Based on all those things, you can now decide that I'm going to invest 10% in bonds, which is a low risk investment, 10% in mutual funds, and 40% in index funds, and I'm going to pick some stocks myself. You can decide that, right? So that's how you allocate your assets. Then the third thing is don't time the market. Many people say, I'm going to wait. Stocks are down now. I'm not going to invest. I'm going to wait till I know that I'm going to make profit. Then I'm going to invest. But you can never know when you're going to make profit. Trying to time the market by buying and selling stocks based on market trends or predictions is a very risky strategy. And if you do not like risk, that is the highest risk strategy that I can think of, trying to time the market, because it's better to invest regularly over time. And this is known as pound cost averaging or dollar cost averaging, or whatever your currency cost averaging. So you decide that, okay, based on how much I have to invest, I'm going to put in a certain amount every month. On the first of the month, I'm going to invest £100 or $100 or whatever amount you decide. You just decide that's it, or even £10 or $10 or £1,000 or $1,000. You're going to invest that every month, and that's dollar cost or pound cost averaging. And that way, you don't time the market when things are on sale. That is when the price is dropping. You're buying shares on sale, and so it works out very well. And staying focused. Yes, staying focused on the long term. So if you are investing for the long term through this strategy, you need to stay focused on that goal, that I'm not going to let my emotions get up and down with short-term upsets, but you're going to stay focused on the long term, and you're going to avoid making impulsive decisions based on short-term market movements, based on short-term drops in the market, based on short-term things happening in the market. Instead, you're going to stick with your investment plan, right? So, and then finally, you can always work with a financial professional. I definitely encourage that, so that you definitely have the education, you have the insight, and you know exactly what you're doing. Next is, so what's next, right? What's your next step? The next step is to make your first investment. And you have educated yourself. You can keep reading books. You can keep, you've attended this webinar. You can keep attending more to learn more. You can book a call with me to find out more. And then the next thing is you want to set your investment goals. So now you want to determine how much money you want to invest. And this will help you decide the strategy that you're going to take. Is it going to be lump sum investing, dollar cost averaging investing? And then you want to decide what type of stocks or funds you want to invest in. So you now know what a stock is, you know what types of funds there are. You want to decide what type you want to invest in. Then you want to open a brokerage account. You need a brokerage account in order to buy and sell stocks. And there are many online brokerages that offer low fees and have easy to use platforms, right? So you want to pick one and open a brokerage account. I did do a course, a free training on brokerage accounts as well. I'll add the link as well. I'll share the link with you as well, so you can see things that brokerage accounts that I talk about, examples of them. And this is not advice, it's just financial education. And then you want to decide on your strategy. And then you want to put some money in. So you've opened your brokerage account, you decided what you're going to be invested in, and then you want to put some money in it. Okay, so I'm going to pause there because we have talked about a lot of things right now. And this is just an introduction, right? Once you now decide that you're putting money in, you can now decide how, part of the next step is, is putting together your investment plan, your investment strategy. And if you want to learn more about putting your investment strategy together, feel free to send me an email, leave a comment, reach out to me on Instagram or via DM, anyhow you would like to reach out to me, and we can work together to just decide, over a quick coffee call, what is your investment strategy and how you would like to put that together. If that would be of benefit to you, reach out to me and let's do that. Okay. Well, congratulations. We've come to the end. Thank you for listening.